Well, apparently we're starting. I have the great pleasure of welcoming you to the law school on behalf of the Law Review. I'm the Law Review Advisor, Robin Wilson. Also on behalf of the Law Center, which is co-sponsoring, and you saw an amazing list of co-sponsors. I won't go through all of them. Actually, my greatest privilege is to recognize two people that are known to both of you, Christine Shepard, our editor-in-chief, and especially Mallory Sullivan, who is the symposium editor for the fine work that they have done, which will be apparent, I think, throughout the next 2 days. So I'm going to turn things over with no other remarks to Mallory.
Okay, again, I'm glad everyone could join us. As a group, the authors that are going to be speaking over the next 2 days are strikingly well informed about how these fringe markets actually function. And the symposium includes eloquent and sincere exponents for vastly divergent views of what types of regulatory structures are likely to create the greatest social welfare. I think everyone here is really looking forward to a respectful clash of ideas. With that being said, I do want to remind everyone that civility is expected. We will open the floor to questions at the end of every panel. And while we do encourage discussion, if everyone would be respectful of different viewpoints. A few other things is please make sure your cell phone ringers are off. And no filming will be allowed. With the only other thing to announce is John Caskey, who we're thrilled to have and is supposed to be doing the introduction. His flight in Charlottesville is delayed, so he will be wrapping up for us this evening. So you have that to look forward to. And we will delve straight into our first panel. So at this time, I would like to introduce Mr. Bruce Miller.
Good afternoon, everyone. As Mallory said, my name is Bruce Miller. I'm a managing director with the investment banking firm of Stephens, Inc. I actually have the privilege of working for Warren Stephens, who is an alumni of W&L and a member of the board of trustees. In my role at Stephens, I focus pretty much exclusively on the consumer finance arena, and we spend all of our time in what we call alternative financial services, but as participants in the fringe banking and fringe economy arena. And as you think about the companies in that sector, there's a lot of the topics here this afternoon and tomorrow: payday lenders, title lenders, small installment lenders, check cashers, prepaid debit cards, pawn, rent-to-own, etc. And it's a fascinating arena to bank. And if you look at kind of where we sit in our economy and our society, there are approximately 60 to 70 million unbanked Americans right now. And I think what is staggering as you look at over the past 3 years in connection with the recession that we went through, approximately 500 to 600 billion of available consumer credit has been removed from the system. That doesn't include changes in the mortgage space, but just credit cards, auto loans, etc. So a massive amount of consumer credit has been taken out of the system. And along those lines, there was a study that came out recently from the NFCC, a Credit Counseling Association, that 64% of Americans couldn't come up with $1,000 if they had to from savings for an emergency, which is just staggering. Now, that's on the demand side of what's going on. On the supply side and what's affecting supply, we've got landmark legislation out there from the Dodd-Frank bill in connection with the Consumer Financial Protection Bureau. As bankers, where we work with companies to help them raise money in mergers and acquisitions advisory, obviously it's a topic that's very close and near and dear to our hearts as we work with our clients, as well as capital providers and investors. So this is an extremely timely topic that we're going to be covering. We're delighted to be a part of it. I want to thank Mallory and Christine for inviting me to speak here. Many years ago, when I had a lot more hair, I was a symposium editor of my law review at Wake Forest, and I completely respect what they've been going through and all the work that has gone into this. So without further ado, I do want to introduce the panelists for the session this afternoon, and we're very fortunate to have three individuals who've written extensively in this arena and have obviously published very interesting articles. First, to my right is Robert Mayer. He's a professor of politics at Loyola University of Chicago, where he teaches courses on political theory and comparative politics. He's published numerous articles on democratic theory and distributed justice, and is also the author of Quick Cash, The Story of the Loan Shark, which I definitely want to get my hands on. To my left is Lance McMillian. He's an associate professor of law at John Marshall Law School, teaching courses in constitutional law and torts. He joined the John Marshall faculty in 2007. Before that, he was a practicing lawyer, civil litigator, commercial arbitrator, and certified mediator. The focus of his practice when he was practicing was centered primarily on complex litigation, class action prosecution and defense, business torts, constitutional torts, and discrimination. And then finally, to my far left is Todd Zywicki. He's a foundation professor of law at George Mason University School of Law, where he teaches in the areas of bankruptcy, contracts, and consumer credit. Before George Mason, he was a professor at Mississippi College School of Law and a visiting professor of law at the Georgetown Law Center. He also served as the director of policy planning at the Federal Trade Commission, and he has published extensively in this arena of alternative financial services and the fringe economy. We reference Professor Zywicki's work on a regular basis, so we look forward to hearing his thoughts this afternoon. So, without further ado, I'm going to turn the lectern over to Professor Mayer to tell us about his article.
Hi, I'm Rob Mayer from Loyola University, and thanks for having me here. I guess I'll warn you straight away. I think I'm the only non-JD who's giving a talk here at these panels over the next day or so. So we're starting with the amateurs, and I kind of feel like I'm swimming with sharks here. But my talk is not about lawyer sharks, but about loan sharks, a topic I have been researching, writing about for the last couple of years. So my paper is called... There we go. Loan sharks, interest rate caps, and deregulation. And my paper is assessing a thesis. I call it the loan shark thesis. It's simple enough. It says that capping the cost of credit will spawn loan sharks. And the idea is that the lower the price that's enforced, the more loan sharks you're likely to have. And it's an intuitively plausible kind of thesis. It may seem true by definition to us. And its advocates of deregulation who typically set forth this thesis, appeal to it. They point out that once upon a time there were lots of loan sharks in this country, but deregulation that came on the scene a generation ago starved those loan sharks into extinction. But the danger is that by imposing price caps, we'll revive that threat, bring back a problem that has largely disappeared. And that thesis is largely asserted in passing. It's typically a sentence or so you might find law review articles and so forth. But it has been defended in detail recently in an article in Banking Law Journal. There we go. Entitled History Repeats Itself. And it offers historical evidence to try to substantiate the loan shark thesis. And the authors argued that the return of the loan sharks is the perverse consequence of price caps in subprime credit markets. Well, my aim in this paper is to test that thesis against the historical evidence. And the paper draws on material that formed a book that I published last year. It's entitled Quick Cash. You can get it at Amazon.com for $23.95. And it's subtitled The Story of the Loan Shark. But it's really a history of payday lending since the birth of that product at the end of the Civil War. So a 150-year story I try to tell about the development of this particular financial product. I argue in my piece that, well, of course, everything depends on how you define loan shark. What is a loan shark? We've got to be clear about that. But what I'm arguing is that depending on how we define loan shark, this intuitively plausible thesis is either false and exactly wrong, or it's too simple and thus misleading. So I'm challenging that thesis then. What I show is that over the course of a century, two kinds of creditors in this country have been dubbed loan sharks. One of them used violence to collect its debts, but the other has not. And the non-violent kind of loan shark came first and has always been more common than the other type. And the actual patterns by which these different creditors have flourished contradict the loan shark thesis I'm trying to show. If we take the violent sort of lender who engaged in something like payday lending, mob payday lending, middle of the 20th century, well, the point is that it emerged after interest rates and caps were raised considerably, not lowered. So it appears after the caps go up. And those violent lenders appeared only in certain places, but not ubiquitously, not a pervasive kind of lending model. And that sort of violent, mob-connected payday lending died out well before deregulation came on the scene, beginning at the end of the 1970s. So the pattern doesn't fit well the story the loan shark thesis is trying to tell. And that illustrates sort of the basic shape of the problem here. What the data suggests that doesn't look like what you'd anticipate based on the thesis itself. The non-violent sort of loan sharks, about which I'm going to talk a little bit more, well, they have thrived either when interest rate caps were very low or very high. And so the shape of the pattern looks a little bit different here. And these figures are just suggestive. They're not meant to be mathematical, not measuring in any precise sort of way. But the point that I want to make is that this non-violent sort of loan shark was most restricted when rates were set at a moderate level in between the extremes. If the loan shark thesis was true, then the figure on the left, the expected figure, would be true. It would be downward sloping, fewer loan sharks as interest rate caps rise. But the actual pattern is U-shaped, as I'm showing. And so it suggests that there's a more complicated relationship going on here than the loan shark thesis can recognize. And the policy point I would make here about credit regulation is that if we're concerned to reduce loan sharking, if that's an aim of public policy, then both types of these loan sharks should be a target and not just one. That is, the aim ought to be to minimize the total quantity of loan sharking and not one particular type itself. And the policy that has done that best, I think, over the last century has been the moderate price cap. In general, the position I would want to defend here and elsewhere too is that a rate cap at some level for products like payday lending is a justifiable policy, desirable. Now, the cap might be very high. It could be as high, for instance, as $15 per $100 borrowed, which is an APR of 391%. And that's high indeed. Some of the papers you'll hear about at this panel say that that's the average price for payday loan in this country today, and that's actually not quite true. The average price is a bit higher than that. 15 per 100 is on the low side. But the point I make here is that $15 per 100, that's a government price. That is not the free market price for payday loan. The free market price for payday loan will be substantially higher. It won't be in the teens, it'll be in the 20s. In fact, it'll be 30% higher. So there's a real cost difference here that results from whether we impose price caps or not. And the other general point I want to make before I kind of dig in quickly here is that too often the specter of the loan shark, the violent loan shark, has been invoked to discredit credit regulation. And the point my paper is trying to make is that deregulation has perverse consequences too. You're not going to avoid perversity and perverse consequences no matter what you do here. There will be perversity, I think, is a lesson I'm trying to teach. And so the aim should be here not to get rid of it, but to minimize it, because we confront dilemmas, contradictions, inevitably in this particular sphere. Well, all right, I can't go any further without talking about what a loan shark actually is. And so let me raise that question. What is a loan shark? The term doesn't have as I understand it, a legal status in most jurisdictions. I think the statute in Wisconsin actually uses the phrase loan shark, but typically that's not so either federal or state laws. But of course, these days, loan sharking is synonymous with what's called the extortionate credit transaction, which involves violence or threats of violence. And that's typically what we associate with loan sharking now. But the point I want to make is that that's not always what loan sharking meant. The meaning was significantly different once upon a time. And I think it's valuable to recall our history here as we think about what to do about subprime credit products in the 21st century. Loan shark, the phrase loan shark, is an Americanism. It's a colloquialism, and it emerged first late in the 19th century, so the word's been around for more than 100 years. And at the start, and for decades, the phrase had no associations with violence. It didn't suggest somebody was going to break your legs if you failed to pay back your debt. Instead, that phrase was applied to vendors of expensive small loan products. Let me give you an example there, one of hundreds I could cite. These were the first payday lenders. As I see it, we're actually in the third wave of payday lending in this country. It's been going on for a long time, taking different forms. But it's useful to recall the first payday lenders and how they were regulated 100 years ago. They called themselves salary lenders, salary brokers, salary buyers, and so forth. They typically secured their debt with a wage assignment. And the price for their credit, well, typically 10 or 20% a month was the amount that they charged, which is on the cheap side for a payday loan these days. So the product hasn't gotten cheaper with time. And the shark-like feature of that product that called forth the epithet of loan shark, it wasn't the method of debt collection. Salary lenders didn't attack people, harm them physically when they tried to reclaim their debts. What was the shark-like feature of the transaction? What was the structure of the deal itself, which took the form of a trap for many of the customers of those products? The salary loan was typically an unamortized debt that rolled over again and again, and which served as a kind of interest-only product that trapped working people all too often. It's fascinating to go back and read earlier accounts of loan sharking, what was meant by the term. I'll give you just one example here. A famous manual, Neiffeld's Manual on Consumer Credit, published in 1961, in which there's a definition offered of loan sharking. It's an authoritative source, and Neifeld said this. He said, "The essence of loan shark deals is small amounts for short terms with an effort to keep the principal out all the time to secure repeated renewals of the interest charge. Loan shark evils appear where the method of lending requires the entire indebtedness of the wage earner to mature at one time. The inability to pay anything but the interest on the loan almost inevitably results from this method of lending money." And that is what payday lenders have tended to do through all the waves of payday lending over the last 100 years or so. The idea that loan sharking involves violence only came on the scene and became cemented in language and in modern thought in the 1960s, in fact. It's a pretty recent innovation. And there's another example from a more contemporary period. The mob entered the payday lending business in the middle decades of the 20th century. And as one kind of loan shark began to disappear, a different type came to dominate the idea and shape the meaning of that word. And that transformation was possible, in fact, precisely because of the success of progressive reform in the first half of the 20th century, which killed off the older type of nonviolent loan shark, and so opened up the space where a new conception of what loan sharking involved could be established in the popular mind. And the mob form of payday lending, when it operated, well, of course it used violence or threats of violence, and that made it different from earlier kinds of loan sharking. But in other respects, the product was structured in just about the same way, we need to see. There's a common denominator between violent and nonviolent loan sharking. And the common denominator is debt trapping, constructing products in such a way that people get stuck and can't escape them very easily. What loan sharks, whether they use violence or not, have always done is to vend an ostensibly short-term product that's so designed as to handicap repayment. And so I would say that you know a loan shark not by whether he's going to break your leg or not if you fail to pay back the debt. You know a loan shark by the volume of expensive renewals that this lender engages in. Well, let me tell you about the relationship between rate caps and these two kinds of loan sharks real quickly, and then sum up. The non-violent loan sharks came first on the scene, so I want to talk about them to begin with. And there were lots of them 100 years ago in this country, when rate caps were very low. The average usury cap in the various states 100 years ago was about 7%, the most that you could charge for loans. And it was impossible for white market firms, banks, to lend people small sums at that kind of rate, just financially impossible to do so. And so debt trappers proliferated in the gray and black markets to satisfy the demand of a new urban working class that had grown up in the wake of the Civil War. So you get lots of these kinds of nonviolent loan sharks when rate caps are very low. Definitely true. But the trick is that at the same time, in other places, we're getting lots of the same kinds of loan shark behavior in places where there were no rate caps at all. Great Britain is the best example. It removed its usury cap in the middle of the 19th century. But by the turn of the 20th century, they were having the same sorts of problems that were occurring in the American states. In Britain, they were called money lenders. And the accounts suggest very comparable kinds of products, similar kinds of tactics deployed there too. So you've got a puzzle, no rate cap at all, but lots of loan sharks. And then lots of loan sharks where there's low caps as well. Well, of course, there has been lots of this kind of payday lending in America the last 2 decades. The product coming on the scene first in the 1980s, during the era of financial deregulation. And honestly, what the payday lenders do today is pretty much what salary lenders did 100 years ago. There's a lot of comparability between those kinds of products. And the period when we had the fewest of these non-violent loan sharks, well, that was in the middle of the 20th century as a result of a landmark piece of legislation, Uniform Small Loan Law, brought into existence most of the states in the first decades of the 20th century, one of the great triumphs of progressivism in this country. And what the USLL did was to establish a moderately priced and amortized alternative to the salary loan, and established, too, a whole industry, which came to be known as the personal finance companies that vended this product, with a price tag and an APR of between 30 and 42%. Was the going rate for those kinds of loans in their heyday. If you're over 30, you'll know that HFC stands for Household Finance Corporation. And it was the dominant player in this field, middle of the 20th century, the largest nationwide chain vending these amortized and moderately priced products. What you might not know, though, is that HFC was born actually as a loan shark firm. It operated in the black and gray markets at first, around 1900, but then with other lenders joined progressives and regulators in creating this new product that was amortized and that improved the position of working people. Well, now, quickly to tell you about violent loan sharking be done. And the first point I make, and which I elaborate about more in my article and book, is that the stereotypes we have of these violent mob-connected loan sharks don't match well their actual operations. Our images are mostly fabricated by Hollywood. And if you've never seen the George Raft classic loan shark, I do recommend it. It's interesting because it describes a mob payday lending operation. It's catering to working people. It creates the image that we have even now. But about violent loan sharking by mob-connected operations, what you've got to see is that rate caps didn't spawn them automatically. There's no cause and effect here in any direct sort of way. Then and now, there are plenty of places with low rate caps and no violent loan sharking. I'll give you an example. Vermont, the state of Vermont. The usury rate in Vermont is 18%, one of the lowest in the country. And if the loan shark thesis was true, Vermont should be overrun with violent loan sharks, but it's just overrun with crunchy granola types instead. As far as I can tell, there's really no violent loan sharking going on in the state of Vermont whatsoever. And that raises problems about the thesis, it seems clear. And where violent networks of loan sharking have operated, Well, the scope has always been restricted, and other factors clearly seem to matter in bringing it into existence where it has happened. The first place that mob-connected payday lending operations worked, New York City, boroughs of New York, 1930s, right at the end of the Prohibition era, is when it first came on the scene. But there's a puzzle here, too, because New York State had raised legal rates for small loans substantially a couple of decades earlier, and no loan sharks of violent sort immediately appeared. There was a lag in time of several decades, greater in other places too, like Chicago, where the juice men operated in the 50s and 60s, but Illinois had raised its rates decades earlier. And so I think we need to see that there's no relation of cause and effect between price caps and loan sharking of the violent sort. This form of payday lending by mob operations, which flourished, especially in the 50s and 60s, disappeared before deregulation came on the scene in the late 1970s. So deregulation can't claim credit for this good turn of events. What happened is that the market evolved. The change came from the inside as mob-connected organizations began seeking out new, more lucrative populations. In fact, they were doing it at the same time what the personal finance companies were doing, seeking more upscale people, redesigning products, and so forth. Because they discovered what payday lenders, I think, always know, working people with bad credit, they're a tough market to service, and there can be greater riches in other kinds of places. And so the kind of mob loan sharking that has endured and survived beyond the 60s, well, its target populations have been gamblers and small businessmen and other criminals, different from the population that is served by payday loan products now and in the past. Tony Soprano never gave a loan to a single mom seeking emergency cash, which is the kind of market where payday lenders operate now. The facts contradict the thesis, and it's also important to recognize that violent loan sharking has appeared where there have been no rate caps at all. Great Britain has a loan shark problem these days, violence and so forth. But Britain removed its usury cap in the mid-1970s, so there's no limit on the price that you can charge for credit, and yet there have been hundreds and hundreds of stories like that one about violent networks of loan sharking at places like Great Britain. Chicago, where I teach, is another example. There are credible reports of violent loan sharking occurring on the south and west side of Chicago back to the 1990s. But the trick is that Illinois removed its usury cap at the start of the 1980s, and it was developing a payday loan market in the 1990s when these violent forms of loan sharking flourished. The movie Barbershop with Ice Cube is a good example of what we're talking about there. And so the two markets operated side by side. It's not that the payday lenders drove the violent ones out of business. And so what we should see then is that even the freest market can spawn violent loan sharks, even if there is no rate cap whatsoever, because the truth is that some people will not be able to borrow unless you can threaten to beat them. That's just a reality. And so you'll never be rid of that kind of violent loan sharking. But it also isn't pervasive either, we should see. So the fear that mob-connected loan sharking is going to return if payday lending rates are capped is mostly hype, we ought to see. Today's illegal lenders are not mobsters at all, but they are on the internet. And those internet lenders, which abound and proliferate, they can threaten debtors in various ways. But they're in no position to beat them because they're probably thousands of miles away, and I've never seen a single story about an internet lender who actually physically harmed a debtor in arrears. So violent loan sharking isn't the kind of problem we face in the illegal market these days. And illegal internet lending is accessible anywhere. It doesn't matter if your state has a rate cap or not. You can access it. And so it's a problem for every state, whether it has loan caps or not. Let me sum up. The claim in the loan shark thesis is that history is going to repeat itself if the price of credit is capped. And my conclusion is yes and no. No, imposing rate caps does not and will not revive mob payday lending of the sort that once did exist in this country. That's a historically contingent episode. It isn't a perennial threat, and it's not the danger we face, certainly in the 21st century. But I would say yes, in another sense, The loan sharks of old, what a loan shark was at the start, they have returned in the 21st century. And in some senses, we are right back where we were 100 years ago in this country in terms of the problem with short-term, high-price credit. And what we need to see is that it's the deregulation of credit that got us there. All right. Thank you very much for listening.
All right, thank you, Professor Mayer. Next, we're going to have Professor McMillian tell us about drug markets, fringe markets, and the lessons of Amsterdam.
I want to thank you guys for letting me be here today. I've never been to Lexington before, and I explored the town on foot, walked around everywhere, and I called my wife and I told her, honey, I have something to tell you. I'm in love, and her name is Lexington, Virginia. Her sister was an undergrad here, and she goes, well, you know there's nothing to do there, right? And she's just jealous. So drug markets, fringe markets, and the lessons of Amsterdam. And my wife asked me what I was talking about before I left, and I said that very topic. And she said, she waited for a second, she goes, did you say Amsterdam? And I said, yes, I did say Amsterdam. And if you're out there wondering, like, what is Amsterdam? My talk comes from a show called The Wire, which came on last decade on HBO, and it's the greatest show of all time. And I'm not kidding about that. I wrote it in the paper. You can cite it going forward. It is the greatest show of all time. And if you take nothing else away from what I say today, if you haven't seen The Wire, watch The Wire. It's transformative. Especially those of us who are interested in law, you have to see it. I mean, it's not just about drugs. It's about labor unions. It's about education. Season 4, I'm going to talk about Season 3. Season 4 is the single best season on television. Dealing with the education of these 4 kids will just break your heart. So just watch The Wire. I mean, that's the big takeaway. So The Wire arises in Baltimore, inner city Baltimore, and it exposes at least me to a world that I wouldn't otherwise know. I mean, I'm a white guy who grew up in suburban Atlanta. I mean, I don't know anything. But the people who created The Wire, David Simon and Edward Burns, they were from Baltimore. There were police officers in Baltimore, school teachers in inner city Baltimore. They actually lived in the drug corners of Baltimore one year, wrote a book about it called The Corner. And then the HBO did a movie on that, and then they decided to do The Wire. So these are guys who have been there, and they're sort of relaying their firsthand impression of it. And it exposes me and other middle-class folks like me to a world we just don't know about. And for that reason, I think it's a very important window to the problems that we hear about from afar. It's a window that gives us a sense of maybe real life, but through the characters of what maybe some solutions to what's going on, to problems that seem chronic. And throughout the 5 seasons, drugs and the drug war play a very important role in the story. In the very first episode, one cop goes, it's wrong to call the drug war a war. And a skeptical colleague goes, well, why? And he said, because war's in. And the drug war doesn't end. And the reality of the fact that the drug war doesn't end really means that it hasn't ended and the drugs won. We fought the drugs and the drugs won. So it's that inevitability of drugs that influence the actions of someone called Bunny Colvin, who there's not really any heroes in The Wire except maybe Bunny over the 5 years. And he's a police lieutenant nearing retirement, and he's looking back over his life, and he has this existential crisis. Like, did my life matter? He says, the city's worse than what it was when I got here. What does that say about me? And just frustrated with this drug war and the police the corner strategy. You throw the low-level drug dealers in jail. The next day, there's new guys. Throw them in jail. The next day, there's new guys. You just keep on doing it, and nothing changes. The violence continues. The despair continues. Nothing changes, and he decides, look, I'm going to be out of here in a couple months anyway. I got my major's pension. I got a nice job with Johns Hopkins lined up. I'm going to try something funny. And I'm going to experiment. And his idea is drug-free zones. Legalized drug zones. And so he has these 3 abandoned sections of his district. And he tells the drug dealers, look, you stay within these blocks, I'm not going to touch you. You come out of those blocks with the drugs, we're going to be on you like never before. So he's offering them a trade. He said, I will legalize what you're doing if you contain yourself. So a trade of legalization for regulation, as opposed to the criminalization model that had been enforced before. And the drug dealers they're suspicious at first. There's this entrapment. Something's afoot, and one of them goes, "You mean like Amsterdam?" Meaning Amsterdam, but he says Amsterdam, and that's where the name grows, the Amsterdam. And these dens become known for this throughout the city. And Amsterdam succeeds in what Coleman wanted to do. Coleman's thing was, look, we have a lot of law-abiding people here who are getting caught up in the drug war. Let's move the drugs to isolated places and we'll transform the rest of the neighborhood. And that's what happens. You have this transformation across Baltimore, western Baltimore. The violence goes down. The arrests go down. It's just stunning success. The corners are crime-free because everyone's in Amsterdam. And the residents, for the first time, have hope. And hope is something that's been in short supply in Baltimore for a long, long time. Not all is great, though. Within Amsterdam itself, there is despair. I mean, you just imagine, it's an anything goes zone. Open drug use, overdoses, reckless sex. There's no drinking water, no electricity, no toilets. You can imagine the human depravity there. As Robert said, there will be perversity, and that's what's happening. And the deacon, who's a character who's a friend of Coleman, says, look, you've created a great village of pain within Amsterdam. And Coleman's a little defensive. Look, it's the same as they were before. They're just all in one place. And the deacon goes, well, that place is hell. So it's not all nice and sunshine. So Mayor Royce finally, it's been hidden from him for a while. He finally learns about Amsterdam, and we would expect, as the audience, from watching him the first 2 seasons, oh, well, he's going to shut this down because all he cares about is re-election. But he has a moment of conscience. He sort of becomes intrigued with the idea that this is actually working. Nothing else I've ever done is work. Maybe there's some chance here. But the problem is the politics of it. And that's where Tommy Carcetti, who's a councilman, enters. He wants to be mayor. And because of Amsterdam, the crime statistics drop. And Carcetti is a little suspicious. So he goes with Coleman. They tour the Western District. Carcetti sees for himself, wow, there's been a complete transformation of West Baltimore. But then Coleman takes him to Amsterdam, and he sees the bad side, too. And Carcetti faces a choice. Do you embrace a policy that seems to be working, the first idea in any time that's produced meaningful change in the city, or do you use this as a political weapon against the mayor? Because this happened on the mayor's watch. And he chooses the politics of it. Even though he's built up to this point to be idealistic, he chooses his own self over the good. And it goes public. And Royce, who had been having these thoughts, this might be a good idea, the news media goes to Amsterdam, shows all the stuff that I talked about on television. Royce sees it, and he goes, what the F was I thinking? Because politically, it's just dynamite. And Carcetti's there giving interviews, attacking the mayor, and so this great idea goes away. You send in the cops, they arrest everyone in Amsterdam, they send in bulldozers and bulldoze it to make the public spectacle that, look, we're destroying this. This was one rogue cop. Coleman loses his major pension. This is the hero now of the whole series. Loses his pension, loses his job that he had lined up at Johns Hopkins, and it shows the penalty for taking risk in the political arena. All right, so that's the Amsterdam story. And so what I do is I use that as an analogy for, while we're here, the fringe economy piece. And I draw 3 lessons from Amsterdam that I apply to the fringe economy. And the first lesson is markets arise wherever there exists market demand. I mean, that's not a huge insight. Long ago, Adam Smith, but I mean, that's my first lesson. That why do people do drugs? Why do we have this drug market? Why do people utilize fringe market economic products? I mean, just step back. Thinking of both of them, this just screams bad idea. Why would you do that? Well, there is this demand. And when we see this demand for low utility or no utility products, I think the human tendency is, well, let's just ban it. That's bad. It's not good for you. You shouldn't do it. Let's ban it. But the problem with bans, which is a supply side solution, we'll just eliminate the supply of drugs. We'll eliminate the supply of fringe economic products. The problem with that is, well, you haven't done anything to take care of the demand. And as black markets across the world show, where there's demand, supply is going to rise to meet demand, even in the face of whatever law says, well, you can't have that product. That's why we have this vibrant black market, both in this country and throughout the world, is because demand persists. And supply side solutions can't deal with the fact that demand is still there. So the application to the fringe economy is that markets are going to exist one way or the other, and there's just this abiding skepticism I have towards supply-driven solutions to this area of the law, because they don't affect this inevitability of demand. And that's where Bunny Colvin came in. He's like, look, drug demand and drug use is inevitable. Let's acknowledge it, embrace it, contain it, instead of this fiction that we'll just ban it and somehow deal with it that way. So that's lesson one. Lesson two is that legalization and regulation, not prohibition, represent the best method for controlling the negative externalities of fringe markets. What is Amsterdam? Essentially, it's Colvin's attempt to transform the drug market from a black market to a fringe market, to make it there on the periphery, but legalized in its own way. And so we accept the premise of lesson one, that markets arise wherever there exists market demand. And the question is, what's the best way to control the demand that's going to exist one way or the other? Is it through legalization and regulation, or is it through law enforcement and prohibition? And I would submit that it's through legalization and regulation, at least in the case in the fringe economy context. We see with prohibition in the drug context, the negative externalities, the increase in imprisonment, the violence, the Mexican War that's a byproduct of the fact that drugs are legal here. There's this cynicism of the system effects. William Stunt's book, The Collapse of the American Justice System, talks about the fact all these citizens that we have in jail for these drug crimes, that creates a wave of distrust towards our justice system. And there's a cost to that. So what the regulations should look like. I talk about a few things in the paper, but I'll leave that mostly to the true fringe economy scholars here. But the fundamental point is that prohibition is a solution that we should approach very carefully and skeptically from my perspective. Instead, go the regulatory route and think outside the box sometimes, knowing that demand is always going to be there. All right, so that leads to lesson number 3: mustering the political will to provide legal sanction to the fringe economy is a difficult, if not an impossible task. Now, what I just said is that the best way to handle fringe economy problems is to think outside the box, and that's lesson 2. Lesson 3 says it doesn't matter if you think outside the box or not, because the politics of being innovative in this area make meaningful change impossible. The problem is politicians are scared to be innovative. It's not in their self-interest because it creates risk of electoral defeat. Again, Amsterdam didn't fail because there was something wrong with what it was doing. I mean, everyone who thought about it, said it was a good idea. Even recognizing the hardships of Amsterdam itself, even in the Amsterdam zones, health officials were starting to say, look, this is a good idea to have everyone in one place. We can send in the social workers, the medical personnel to treat, to test. This is a great thing. The former mayor of Baltimore in real life, Kurt Smoke, played a character on The Wire and made that very argument. And it's sort of life masking or fiction mirroring real life, because when he was mayor, he sort of floated the idea of, look, maybe we should legalize drugs, and got killed for it, of course. And that's the problem. You get innovative in an area that's politically unpopular. You legalize drugs, well, that's silly. I mean, no one talks that way except Ron Paul, and I mean, Ron Paul's crazy. And no one even takes his ideas seriously, because part of his charm is that he's crazy, so he can say anything. So no one makes that argument because it's too easy for an opponent to use that against you. I mean, it's electoral suicide. My little girl was Dorothy for Halloween, Wizard of Oz, and she's been watching a lot of Wizard of Oz. And so I think of the lion, the courage. You have courage, and there's no courage in the current political culture. Now, drugs are different than the fringe economy. I think there is more room to operate in the fringe economy because it doesn't have the exact same stigma as drug use. But no politician is going to stick out their neck to defend payday lenders. I mean, why would they? I mean, they're not nice people necessarily. I mean, my brother is one, and he hates it. He doesn't make any money. He has to make the calls. He's low level. It's just it's not something that's going to be politically viable. And prohibition is an easier solution to sell. Well, these payday lenders, they're taking advantage of the poor. We should stop that. We should ban it. I mean, that natural human tendency. Well, let's just ban it. And that's the political tendency, too. We'll just ban it. That's the solution that's more sellable to the public. As I say in the paper, prohibition is a blunt instrument, and regulation is a tool of nuance. But the public understands the blunt instrument more than the tool of nuance. Still, there is more greater room in the fringe economy context than the drugs, just because drugs are more of an emotional response there. But it's still, you can't go too far off the reservation in this area without incurring political risk, and there's no reason to. There's no reason to be innovative. It doesn't get you anything at the end of the day as a politician, just doing a cost-benefit calculus. And the only people who are actually, maybe the industry can give you some contributions, and that may spur you to innovate. I mean, because it changes the cost-benefit calculus from your personal standpoint. But otherwise, just as a way to get votes, there's no reason to be courageous in that area. So then, I didn't put this in the paper, but what do I think is the solution to the fringe economy? I'm skeptical of solving it from a public policy type perspective. I mean, I think the solution ultimately is going to be sort of a personal finance type perspective. I mean, everyone could listen to Clark Howard and Dave Ramsey and Suze Ortman and get their personal finances in order. I mean, that's the way to solve this, because I mean that's going to alleviate the demand for these products in the first place. I was a plaintiff's lawyer, class action lawyer before I went into the academy. I had a student who came to me and said, well, how do you get rich? That's what they asked me. How do you get rich? I didn't say, well, you don't borrow $100,000 to go to forfeiture law school. That's a separate symposium. That's a separate symposium. I'm having a crisis of the soul. We'll talk about that some other time. But it did say, you don't trade in wives, houses, or cars. I mean, that's how you get rich. And just things that Bruce said, most people in this country can't even raise $1,000. But if you trade in cars, you're incurring more debt, you're moving up. You trade in houses, you're incurring more debt, you're moving up. Trade in wives, you're incurring maybe alimony or child support, monthly obligations that effectively are debt. And this debt problem is going to spur this demand for these products. And until you solve that, I think all this attacking from the supply side is just going to be, maybe you can nibble at the edges, but it's demand that really is the driver from my perspective. I'm skeptical of a lot of stuff. All right.
All right, thank you, Professor McMillian. Next, we're going to have Professor Zywicki speak to us about the economics and regulation of bank overdraft protection.
Thanks, and first, thanks to also to Washington Lee Law Review for organizing this, and also, of course, to Jim Hawkins, who's the intellectual godfather of this. It really, we were talking earlier, there could not be really a more timely issue, and an issue that has been, I think, relatively underexplored in the academy, given the importance of this issue. What we see is that the importance of the fringe lending sector has been important for a while, and it's growing. It's growing as a result of the things we've seen in the past few years. Right? First, the credit crunch, and then the responses to the credit crunch that have exacerbated the reduction, as was suggested, to access to mainstream credit. The CARD Act, which made credit cards harder to get. The Durbin Amendment, now, which is throwing people out of the mainstream banking system, Dodd-Frank generally, and that's before even CFPB has come on. And I don't think anybody has argued that CFPB is going to increase access to credit or reduce the cost of credit, whatever one thinks of that. Some may think that there was too much access to credit, but I don't think anybody's argued that CFPB is going to increase consumer access to credit or reduce the cost in general. So I think what we're going to see here is something that's much more important. I'm going to talk about overdraft protection. One of the things that was very striking to me when I turned to this question was how little has been done on this. There's a lot of newspaper stories about it. There's been a lot of regulatory smoke with a little bit of regulatory fire. But there's very little knowledge about bank overdraft protection, who uses it, why they use it, and how it fits in with other elements of consumer banking, retail banking. And one of the things that was striking to me is when I started off working on this, I had thought that there would be, every time I study a different fringe lending product, I'm surprised at how much different the way it is used is from how people perceive it. I wrote an article about a year or two ago on auto title lending. And when I started off working on that, I assumed it was just like, say, payday lending, which there's been a fair amount of literature on payday lending. Auto title lending, totally different. Totally different. And that would be a topic for another day, but very, very strikingly different. And I thought the same thing when I started off with overdraft protection, that in many ways it was like payday lending, and in some ways it is. It's not as disparate as auto title lending was, but in many ways it's different. And in particular, the kind of people who use it and the way it fits with the way people organize their finances are a lot different. And so again, I think it's another example of a situation before we sort of blunder in with regulation. We want to make sure we've actually got a good factual basis and not just anecdotes and newspaper stories, but a good factual basis. And I don't claim to be providing a definitive factual basis for understanding overdraft fees. What this is a kind of a first stab at what we know about it, and I've managed to get my hands on some data that a medium-sized regional bank has given me, and some other data. And so this is sort of the first step to try to understand this. But it's going to be important because I suspect that overdraft protection will be one of the first things that CFPB is going to turn its sights on, especially because without a confirmed director, they can't do anything about payday lending and those sorts of things. So I wouldn't be surprised if CFPB looks at overdraft protection very seriously. In 2010, there were 13 million overdraft customers. It generated about $35 billion in revenue for banks. What we know is that overdraft protection the usage by consumers has risen over time. The revenues have risen over time. And the number of banks that offer overdraft protection have risen dramatically over time, starting from 2001. An FDIC study in 2006 found that 86% of financial institutions now offer overdraft protection. 40% offer automated overdraft protection, which is basically where if you overdraft your account, it just automatically grants the overdraft rather than having a discretionary choice made by a bank officer. Larger banks have been most likely to offer automated overdraft. 76% of larger banks in the 2006 FDIC study offer overdraft protection, which is automated overdraft protection. So that's obviously higher than the average. And 70% of banks with automated overdraft protection had implemented them since 2001. So it's something that has risen dramatically. The average fee, from what we can tell, is about $26 is the average fee, and larger banks charge more, $35. So what we've seen is the number of institutions offering overdraft protection has grown. The number of consumers who use overdraft protection have grown. And banks, larger banks are the ones that offer overdraft protection. And so the banks that offer overdraft protection have grown relative to the market at large. So basically banks that offer overdraft protection, or probably more precisely overdraft protection as part of the constellation and bundle of services that they offer and prices that they offer, have grown as well. So the consumers have tended to gravitate towards banks that offer this. You can't say that much about that because there have been mergers and everything else. But what we see is consumers using it more, banks offering it more, and banks that offer it grow. Sort of a standard economic presumption would be that if you see millions of consumers voluntarily using a product that more and more banks are offering, one would usually draw the presumption that it's making consumers better off. That's, at least as a starting point, one would assume the consumers are better off as a result of access to overdraft protection. They're choosing it. We'll talk about why that might be. That's the center of the paper, which is why it might be that consumers are better off with access to overdraft protection, both understanding why particular consumers use it, as well as why overdraft is part of a larger bundle of services and prices maybe the consumers like. Yet the assumption seems to be, and it's, that somehow this revealed demand of consumers is wrong, that we can't draw the usual assumption about revealed demand of consumers or market competition about how consumers are using this. We've seen regulations by the Federal Reserve, FDIC, and OCC on safety and soundness, very weak safety and soundness arguments. But really the question, I think, will be CFPB and whether or not CFPB moves to attack overdraft protection out of the box. So what's going on here? Well, as I said, when I first started thinking about this, that the perception of overdraft protection is it's something that preys on lower income consumers, right? It's a product for lower income consumers. Well, as an initial matter, in some sense, that's quite obviously wrong, in some sense, which is, if you think about it, overdraft protection historically was not a low income consumer product. It was a high income product, right? Which is banks cleared the checks of the doctors and the lawyers who either had liquidity problems or whatever, but basically it was a service offered to high-income consumers who banks knew were going to be able to pay for it. Low-income consumers just simply had their checks bounced, right? They just had them returned. Now, so the background is that this is a product initially offered to high-income consumers that has spread to low-income consumers over time. Now, what we saw, and so, and I talked a little bit about the history of that. The second thing we know about is, according to the surveys we see, consumers who use overdraft protection generally, and somewhat overwhelmingly, are glad that the bills that were paid using overdraft protection were in fact cleared rather than bounced. So it's clear that people prefer, in the abstract, access to overdraft protection regardless of income. We also know that when the Federal Reserve adopted its rule requiring opt-in of overdraft for overdraft protection for point-of-sale debit card transactions and ATM transactions, we don't have good evidence on that. We've got some surveys on it, but it appears a majority of people opted in to being able to use overdraft protection for point-of-sale debit cards and ATM cards. Perhaps more importantly is the heaviest users of overdraft protection are the ones who are most likely to opt into using overdraft protection. I think the mental image we have is that overdraft protection is for irresponsible college students who overdrew used their debit card to buy a cup of coffee and it cost them $35, right? And surely that explains some small fraction of overdraft protection. But there are people who use it a lot. And those who use it the most are the ones who are most obviously the ones who value it. According to one study, 86% of heavy users of overdraft protection said it was very valuable. One bank, when they started doing opt-in for ATM fees, where you would have to pay an overdraft to take out an ATM fee, you would go to the ATM machine and would flash up a message, your account will be overdrawn, do you want to pay an overdraft fee? 92% of people who saw that said yes. Of the 8% who said no, 44% came back within 24 hours and accepted the overdraft fee. So in the end, 95% of those confronted with the need to opt into an ATM overdraft did so. So that there is obviously some high demand for this and high demand for the highest. Now, having said that, only a minority of bank users use it. 75% of bank users never use overdraft protection. Another 12% use it less than 4 times. But then what we've got are other people who use it dozens of times over a year or two. And so what we got is this unusual product. And that's what we're looking at, or what I'm looking at in the paper. Now, what explains who uses overdraft and why they use it? Well, one thing that seems to be the case, again, based on what we know, which isn't a lot, is that income doesn't seem to be the driving factor. Historically, income obviously is not the driving factor. Today, it still seems that income does not explain usage of overdraft. What explains it is credit score. What explains it is creditworthiness. And really what explains it is how good are you at managing your finances, and basically what is your personal responsibility with managing your finances and doing the kind of things that we heard previously. A variety of other factors tend to suggest that it's not necessarily just a low-income product other than that, right? Which is people who use overdraft by definition have bank accounts. So they're not the poorest of the poor, because if you don't have a bank account, obviously you're not using overdraft. According to one bank, 71% of their free checking accounts with less than $250 for an average balance, 71% never incurred an overdraft fee, which was actually lower than the average for the bank, which was 62% never incurred an overdraft fee. So it's certainly very, very easy to not incur overdraft fees simply by managing your finances if you want to. So what's the issue then from a consumer protection rationale? I think I can think of 2 things, which is first is basically, do people use it rationally, right? Is it the case that people don't understand what they're doing and use it rationally? And the second might be a fairness argument. This is what I'm going to spend my last couple minutes talking about, because these are, I think, the interesting issues from a regulatory perspective. So first, do people use it rationally? Well, what we see about consumers is that they basically have a pecking order of how they use consumer finance. At the top is basically credit cards, right? Credit cards today are basically what most middle-class people use, and it's sort of the best thing. The next notch down for most consumers is payday lending. The people who use payday lending basically are people who don't have credit cards, or would overdraft, would go over the credit limits on their credit cards if they were to use it. So they tend, this is generalization though, they tend to drop down to payday lending. Below payday lending then tends to be pawn shops, which are people who can't use payday lending, go to pawn shops, and then below pawn shops is a variety of motley sorts of legal and illegal things, rent-to-own often, things like that. So where does overdraft fit in there? Overdraft seems to fit most comparably to payday lending in what we see. Now, now in general, payday lending is somewhat less expensive than overdraft fees, right? Which is payday lending is $15 per 100. Overdraft fees generally have a flat rate of say $30 per overdraft, regardless of the size of the overdraft. So for certainly small, needing money to clear small checks, payday lending tends to be less expensive for many consumers. So why might people prefer overdraft usage to payday lending? And the size of the payday lending and overdraft markets are pretty comparable in the United States. But one is payday lending is more flexible and convenient for a lot of people, right? Payday lending requires you to go and actually get the money, take it to the bank or pay the bill or whatever the case may be. Overdraft protection, by contrast, can be accessed 24 hours a day, instantaneously and automatically anywhere in the world, right? And so it can be used in a more flexible manner. It can be used at a point of sale and things like that. So there may be the transaction cost of overdraft protection are somewhat lower. I think there may also be, for some consumers, sort of a psychological cost to payday lending, especially perhaps middle class consumers, which is overdraft protection is basically an anonymous form of short-term high-cost borrowing, which is nobody knows but you, in some sense, that you've done that. And I suspect that some people psychologically may not want to go to a payday lender. Third, so payday lending is sometimes just not available. If you've defaulted on previous payday loans, you may not be able to get another payday loan. But the fourth thing, and the one that I think is most appropriate in some research, is that I said in general payday lending is less expensive for many consumers, but not always. And I think this is the good test of whether or not consumers are using overdraft protection rationally given their choices. But just think about the pricing, which is payday lending is basically $15 per 100, translating meaning $45 per 300. Overdraft protection is $30 per 100 or $30 per 300, right? So if you think about it, it sets up a good test of consumer rationality, which is what you would predict is that consumers would tend to use payday lending for smaller loans, for smaller short-term loans, and overdraft protection for larger short-term loans because of the different cost structures. And in fact, according to a study by the Federal Reserve, people do tend to use it in the manner that economics would predict, that they choose between those products basically rationally. We also do see that there is substitution at the margin, that where payday lending is outlawed, for instance, people tend to use overdraft protection more often. So who uses it? Well, basically the people who use overdraft protection the most are those who have the fewest credit options. They are less likely to have credit cards than most people. They are more likely to report that they couldn't get access to any credit if they didn't have payday loans. And when they are more likely to self-describe their own credit rating as poor, and more likely to say that overdraft is extremely important to their personal finances. So it looks a lot like payday lenders, but people seem to be making those choices somewhat rationally. Payday lending overdraft protection also seems to be part of the bundle of banking services that people like, which is overdraft protection. From 2001 to 2009, we saw a dramatic rise in free checking in the United States. In 2001, less than 10% of bank accounts were eligible for free checking. By 2009, it was 76% had risen to free checking, which has brought a huge number of people into the mainstream banking system who previously hadn't because they had to pay bank fees. Since the Federal Reserve imposed its overdraft regulations in 2008, that should have been 2008, not 2009, immediately the percentage of accounts available for free checking dropped from 76 to 65%. Now, of course, the Durbin Amendment is basically effectively is in the process of destroying free checking in America. It's taken it down to about, I think it's 45% now in anticipation of the Durbin Amendment. But it's clear that overdraft protection was a part of that. And the logic is that it makes it possible to bring more people into the banking system because overdraft protection is in some sense an ex post response to a lack of funds as opposed to requiring higher precautionary balances, which would be an ex ante approach. So the other thing we've seen is not just increased access to free checking, but also a reduction in the minimum balances necessary in order to get free checking from about $440 to $186 during that period. So it gives consumers more flexibility in managing their finances. As we see, as the Federal Reserve's imposition of rules on this, and then the Durbin Amendment is taking away, reversing a lot of those changes. So I think the real issue here then is not an efficiency argument. I think based on what we could tell, consumers basically use overdraft protection rationally, the ways we would predict. There's no indication they don't understand how much it costs. The real argument here seems to be a fairness argument, which is precisely the fact that a lot of consumers pay a lot of overdraft fees, and that supports free checking for a lot of other consumers. Now, I'm always skeptical about fairness arguments. I'm completely skeptical about fairness arguments here because cross-subsidies among consumers are ubiquitous in the retail economy. Banking is no exception to that. The idea that some consumers get more than they pay for and some get less, however you define that, I just don't think that's a very good argument. It's also clearly voluntary, and it's also the case that those who use overdraft protection the most also clearly understand and value the product in light of what their alternatives are. So I think the fairness argument is just not a good basis for regulation, and it's just kind of a push. People can make fairness arguments still; they're blue in the face either way. For me, what really brings home the issue is this externality effect, which is that to the extent that overdraft protection, regardless of whether you think it's fairness or not, it clearly is led to an increase in access of free checking and everything that goes along with that. Not just free checking, free online banking, all the innovations we've seen in the banking system during that entire period. So for me, the externality effect of this pricing system has been huge in terms of bringing people into the mainstream banking system, and I think that reinforces the general idea that there's not a problem there. Related to that, there's no evidence that overdraft protection is generating economic rents, or that somehow we still seem to be in a zero-profit equilibrium state when it comes to overdraft protection and the bundle of products that are offered as part of overdraft protection. Why is that? Because we've seen that to the extent that revenues have increased, costs have increased, quality has increased, cost has increased. For instance, there's been a dramatic growth in the number of branches of banks throughout the country over the past decade. There's been incredible innovations in online banking, electronic bill payment, and that sort of thing. So to the extent that there's any value, or to the extent that there were rents or something generated from this, clearly we seem to be in a competitive equilibrium with respect to that. And we're seeing that now. That the other thing that's happening, not just is free checking going away, but the other thing we're starting to see and we'll continue to see are things like reductions. Branches are being closed. One bank announced, IBC Bank announced that it's closing 55 branches in response to regulation from overdraft in the Durbin Amendment. So I think what I would say the general picture is here is the safety and soundness rationales that have been argued are completely incoherent, which is this is a profit center, not a loss center. There's no safety and soundness rationale for regulating overdraft protection. I think the theory of there being a consumer protection argument, I understand the argument, but based on what we seem to have today, I don't think that there's a good case for believing that we need consumer protection, additional consumer protection regulation of overdraft protection. And if we do, nonetheless, get that from the CFPB, I think they're unquestionably going to hurt the people that they intend to help, as is often the case. Thanks.
All right, at this point, we're going to do 20 minutes of Q&A. So if you all will, raise your hand, and the panelists can address your questions if there are any. Okay.
No, I'll wait.
No, that's fine.
So I was intrigued by all the papers. I wanted to ask a factual question, Todd. So I use overdraft protection all the time because I don't like math, right? So it avoids the need to balance anything. But it's free, right? So you had a set of statistics that were about usage, and then a set of statistics about fees, and I just wondered how much of that first set of statistics.
You say your overdraft protection is free?
Yeah, dude, it's awesome. Yeah, that's why I don't do math, right?
Is this a particular credit union or something you have?
Bank of America.
Bank of America gives you free overdraft?
Yeah. But I think you need to look at that because factually, how much usage? The two pieces of your sort of empirical picture didn't quite link up because there's a set of people like you that are getting this for free.
I've never heard, I'll look at that. I've never heard of somebody getting free overdraft.
It could be tied to a line of credit.
It could be, right,
Yeah.
you may have an overdraft line of credit, right.
Exactly.
Thank you for asking that. I ran out of time to do that. And that's one of the things is that you do have overdraft line of credit, which is basically something that's set aside, like, or it can be tied to your savings account and that sort of thing. I talk about that in the paper because that's one of the things that I believe it's the FDIC reg says that, or the OCC reg says, you've got to make consumers who overdraft fairly frequently aware of their alternatives, like an overdraft line of credit or a linked savings account or something like that. And the reality is that people who use overdraft protection a lot, only like 15% of them even have a savings account, right? In order to have an overdraft line of credit, usually you've got, with some sort of line of credit you can draw against, usually you've got to be approved up front, and my guess is you were probably approved for, say, $2,500 or something. It's essentially a loan that you're drawing against periodically. And those heavy users of overdraft protection don't have savings account. They can't get qualified for the kind of line of credit that you have. So that's a different form of overdraft protection. There hasn't really been much regulation of that.
But the data that you gave about all these folks using that is not this kind.
It's not this kind.
It's clearly fee.
It's clearly
charged.
fee-based,
Okay.
overdraft
That helps.
protection.
Thanks.
Where customers typically will have 45 days
They
to
have,
pay it back.
right, they have 45
or
days to
close
pay it back, and it's basically, you pay, say, $30 up front, and then it's like an 18% interest rate. So the fees are very much front-loaded, but you have to pay it back within 45 days or they cancel your bank account.
I've got a follow-up question on that. You talked about, and it was I think it's FDIC guidelines where for habitual users of overdraft protection, you've got to inform them of their alternatives at 6, right? So
Right,
that
6 is
goes back to, if you go back to March of 2005, when the FDIC came out with guidelines, revised guidelines on banks that are in payday lending, that once a borrower had 6 loans in a 12-month period, they have to be provided with an alternative. What's magical about 6? Is it completely arbitrary?
As far as I can tell, it's completely arbitrary. And it's not even clear what problem we're, in some sense, really addressing, right? Which is, most of those people know, right? Most of those people are the ones that are most likely to, they know what they've done, they're most likely to shop. And it doesn't address at all the person who overdrafts once or twice, which is, accidentally, which is a different thing. But it seems like completely arbitrary, the 6 and 12,
I also actually had a question. I thought this overdraft program was really interesting. So one of the things you said is that banks are able to offer free checking because they make a bunch of money from overdraft. But doesn't that mean that overdrafts are more expensive? Because I'm guessing you hear people say payday lenders aren't getting economic rents because it costs a lot. But here, they're definitely making a bunch of extra money. Like if we did a profit analysis just of overdrafts, we would think you're making way too much money on overdrafts. You should charge $7 or something. And so doesn't that sort of, I don't know if that just makes me pause. Like if we thought payday lenders, were at 35% profitability, but they gave 30% to the local zoo or something, we would still think it was bad,
Right.
even though, they had a 30% cost for the zoo.
Yeah, my understanding is that's right. Yeah, that basically what it is that there is a bundle of consumers. There's tens of thousands of consumers, some of whom support free checking for a bunch of for everybody in that. The other thing that's unusual about overdraft, and partly it is that other than sort of this crude measure of credit score, there doesn't seem to be a very good risk models for who is actually going to default on an overdraft loan. So it does seem like what it is a big pile of people are all kind of lumped together. Off of those individual consumers who overdraft, I think it's clearly the case that it's profitable with respect to those consumers, right? Which is consumer overdraft 30 times in a year. you know, the maximum you could lose off of that consumer is $300 or $500 or whatever it is, right? So clearly they're making profits off of those consumers, and so and then what happens is then it gets bundled in with all these other things, you know, the cost, the service, everything else. And so, yeah, so I think that's right. I think it is different from the payday lending model where, and basically because the payday lending model is basically taking money in and putting it out, right? Banking is using this and combining with a lot of other services and things that they're doing, right? You know, free checking, online banking, all these different sort of customer service, running branches, right? All these different sorts of things, and so basically the model you have to ask yourself is there some reason why we should, why government regulation should push us towards imposing monthly fees on people, basically making people pay their own way, versus this particular model? And I don't think there's an efficiency argument. I think the efficiency arguments seem to support this. And that's where the fairness argument hits the road, which is, I believe, is that. So, good. Oh, I'm sorry. Now let them on.
All right. I was particularly interested in the remarks of Professor McMillian. I'm one of those local cowardly politicians. So you can just, you're getting all red. I'm the guy who wrote the resolution that asked for a 36% cap on all consumer financial products in the state of Virginia. It was very, very popular. In fact, in addition to my city council in Stanton that passed it, 99 other councils have passed it, including every single city in Virginia. It's also been approved by the Virginia Poverty Law Center, who was represented here and we'll talk to later. AARP, because they recognize that people who are on disability income and Social Security are often targeted by this type of lender, and so on and so forth. We simply have asked for a cap that would reflect the same cap that was used for military families. And although I don't come from Baltimore, I've never seen The Wire, I will tell you that local zoning or moving something like this into a part of the city that we don't care about is not a possibility really for Virginia. The idea of allowing the creditors to self-regulate has also been tried since 2002. The state Supreme Court ruled in favor of a woman who had been abused so badly that they called it, and this was not the terminology of a law professor, it was the terminology of the Virginia State Supreme Court, that it was a vicious cycle of debt. It also said that 9 million loans from 2002 until 2008 had been made flaunting the law, and that were illegal.
Can I say, is there a question?
There is a question. There is absolutely a question.
I don't mean to cut you off, but just...
No. And I just felt that instead of talking about theory, we talked about the reality. There is an old joke about that one with the Winston. We talked about, advocating for payday lenders. Trust me, they have plenty of advocates. They've spent $5.3 million fighting the very things that 100 cities have asked. And what I would ask you is, how do we advocate for the citizens? How do we advocate for the children of people who have been abused by payday lenders, of people who have flaunted the law, some of which have been thrown out of the state, oftentimes given them maximum penalties? How do we advocate for the people who are in divorces, who are overstressed, and the local charities?
I think we understand the question.
How do we advocate
Professor
for that?
McMillian, do you want to answer that, or President Zywicki?
I didn't argue for laissez-faire. I read the paper. I thought there's different options you can do. My thing is prohibition itself is going to create a lot of unintended consequences that are going to affect the very people that you want to advocate for. I'm not, let's just give up. The second lesson was regulate and think outside the box on how you regulate. And the prohibition, that's the easy, attractive solution. May not be the best course always, but you certainly can regulate. You can be creative with it.
Well, I'll argue for laissez-faire then. The question for you is: so I need $200 or any $100 to pay my electrical bill, and I don't have it. All right, now you've taken my payday lending. I don't have a credit card. What do I do?
Fact is, I think the best.
No, just tell me what should I do in that
circumstance? In that very circumstance,
Yeah.
you call the electric company and you say, "I have a wife and a child in this house, and I need an extra month to pay that light." That's the very best thing to do.
And if the electric company says no?
That's the very best thing to do.
And if the electric company says no?
Very seldom do they do that. There's actually no empirical evidence that they would do that.
I would argue there's probably a very good chance, something that Professor Mayer pointed out, that they would turn to an offshore or sovereign nation internet lender that doesn't comply with anyone's laws, that will loan them money at 35, 100, and you talk about about the loan sharking today, putting them really in a debt trap where there's abuses in the collection process. They'll roll over loans forever. But that's the issue. You look at a state like Washington that put in a very restrictive payday loan law that essentially banned the product, and people have been closing their doors left and right in Washington. And what's ended up happening in Washington? The offshore and sovereign nation lenders have flourished, and consumer complaints to the DFI have gone through the roof. That's most likely what happens to the person that can't pay the utility bill. Let's switch gears on the question.
So, Mr. Mayor, I was intrigued by your paper. It's sort of a nice point that in a lot of places when we raise limits that lower the usury limits, it does not necessarily lead to violent loan sharks. But I was intrigued. You're trying to seem to be making a causal claim that when we have the middle ground, that therefore that leads to the least number of violent loan sharks. And your causal stories seem to be, well, let's look at the middle era of the 20th century, 1940s, 1950s. That's when we didn't have violent loan sharks, therefore that must be the cause. But aren't there an awful lot of other variables that are changing that era, right? Not just usury laws, but we have difference in enforcement laws before the FTC regs that prohibit wage assignments. So very different means of enforcement than today, where payday lenders very seldom sue, for example, very seldom try to collect. That's an era, of course, that's just after the war. There's lots of rationing. Credit as a whole is either, I'm not sure if it's the demand or the supply, but I know that bankruptcies, for example, in the late 40s and 50s are basically non-existent, about 10,000 a year. So I think your first part was very intriguing. The second part, when trying to make a causal claim, I think you got off a lot more evidence than you have.
Could be. There's really two stories going on there. So if you look at just the nonviolent type, it's definitely U-shaped in the sense that when you have small loan law and the moderate price cap, which is 36%, so that kind of nonviolent loan sharking did largely vanish. There was a symposium started in the 50s, very much like this, along the grounds, and they were proclaiming victory. That the loan shark had been defeated in many places where the law was passed. You do get the violent loan sharking that's going on there in that period, mob-connected violent loan sharking. For complicated reasons, I think definitely. The scale, you actually look and try to figure out how much of this is going on and the amounts, and it's real hard to study. Studying legal payday lenders is not easy, scholars will tell you these days. It's hard to get good data. Studying mob-connected payday lending is a lot harder. But in cases where FBI actually did gather in a systematic way evidence, in some places like Philadelphia, the amount of credit being extended is like 43 cents per family. Just teeny insignificant. It garners huge headlines. But as an actual empirical matter, it's insignificant in the scheme of things. But you're saying we need to be complex. I definitely agree with that. And often we take theories and think that they're true. but they're just hypotheses that have to be verified. And I guess the upshot of my paper is to say it's very complicated, and you can't tell a simple story. If we cap prices, we'll get violent loan sharks. No, we'll have problems, but we have problems when we uncap prices too.
We've got time for one or two more questions. Okay.
Also, for Professor Mayer, is it possible that there's a third middle ground category of non-violent loan sharks that are still somehow troublesome because of where the money comes from or where the money's going? You mentioned mob targeting gamblers. I wonder if they're also targeting people with drug addiction, the money's coming from criminal activities or being used to fund other criminal activities. Couldn't that be something we'd be troubled by, even if it's not loan sharking enforced by violence?
Could be so. You know, insofar as mob still operates in loan sharks, the kinds of people, it's not a payday loan problem anymore, I would say. It actually once was. This is surprising to us, I think. The mob began by doing payday loan products and then changed and drifted away. It's still a problem in some places, although it's pretty restricted jurisdictions where you have extortionate credit transactions. But it's not the payday loan problem that we've got to be concerned with. I think is what ought to be recognized. And we're talking about different markets, and we need to sort those markets out. Because when we conflate them, we're creating fears that don't have a lot of basis about what the unintended consequences would be.
I think there's one more question up here. Yes, sir.
I'd like to ask each of the speakers, how do you determine what is a fair price for a loan?
That's easy for me, supply and demand. That's fair price. Supply and demand.
I mean, the market would be my answer.
And my answer would have to be more complicated. And you could say just because we can't pick out some just price, that therefore it's impossible. But what's the fair punishment for armed robbery? Is it, I don't know, it's 5 years or lawyers, 5 years, 4 years? And I don't exactly know what it should be. There's a variability there. We'll have a sense of where it should be. And so for consumer credit products, I'm not sure, but I do think, and this is a different paper, but $15 per 100 is fairer than what I paid in Wisconsin for payday loan, which is $22 per 100, and it's because Wisconsin's unregulated. They can charge any price they want. I paid a lot more, and other consumers in Wisconsin paid a lot more. Because, not because I think those lenders are making windfall profits. It's a very competitive market. But I was carrying lots of people defaulting. They were much less careful in scrutinizing who they give money to. And so decent people who have had their loans are paying more and carrying a bigger burden there. So I think that's unfair. It's a distributive
What What about maybe $5 per 100? Would that be even fairer because then even fewer people would default and you'd have to support even fewer people? How about $1 per 100?
Then the product doesn't work. So if you're talking about payday loans, then what works? But you know, there is a fairness case to be made, and it was made, and it was powerful and pervasive, that something like 36% a year was in fact a fair price. It's relatively recently in this country that that idea was challenged and rejected. And it isn't true that things have gotten uniformly better in this country since that happened. In some ways, things are getting worse.
Well, I think the reason why it's a, but the trade-off is that may seem fair to you, but to a person who can no longer get a loan, a person who can no longer get a credit card and has to use a payday lender, doesn't seem very fair to them, I think. Or a person who now can no longer get a payday loan has to use a pawn shop. That doesn't seem probably very fair to them either, would be my guess.
But it's complicated, and the research would show that it's complicated too. Paige Skiba is at this conference, and she's going to talk about research where, you know, some of these people have other credit options, but they're doing the most convenient things, so rules that force people to do a lower cost but somewhat more difficult thing could be welfare enhancing. So, could be. So it's not automatically true that these people have no options. It's complicated.
We've seen very little of kind of the core products, payday, title, installment, very little price competition. And I would argue none in most markets. And Professor Zywicki, in your comments, I think you had it, this consumer is very attuned to what their options are and what's the most attractive option. Some cases it may be overdraft protection, and in some cases it may be a payday loan. They know what the cheapest alternative is.
Right, and they're not just shopping purely price either, is the other.
Certainly. All right, I think we are out of time, so very much appreciate the questions and you all attending. And thank you to the panelists for your insight. It was certainly interesting. So thank you. Before everyone skews off, we now have John Caskey here. He was delayed earlier, so we're going to receive his forward here at the end.
Actually, I'll make this 5 minutes. I don't want to hold everyone up. I changed this on the fly since it's no longer a forward, so I had an introduction that talked about main themes and so on that people will address, but a lot of them have already come up, so I won't do that. I will just say thank you very much, Jim, for organizing this and for Washington Lee for organizing and hosting. I think that's great. A bit about my own background. I'm not wearing a tie because I teach at a liberal arts school. So rarely ever wear a tie. I started writing about, I'm an economist, and I started writing about fringe financial markets back in 1989, when at the time I was a banking economist, and I heard on National Public Radio an interview with a pawnbroker, and I was in Philadelphia, and I thought, that's really interesting. I wonder why pawn shops died out, because I remember as a kid seeing them in I lived in Oklahoma, whatever, and I said, I don't see any around here. I wonder why they died out. And so I thought, well, I've got a summer research project. I'll hire a student, and I hired some, and I found out there were more pawn shops per capita than there ever had been. It's just they weren't in Pennsylvania because state usury laws didn't allow many to operate there. There were thousands in Texas and something like 70 in Pennsylvania. And so I basically became educated about pawn shops. But that also sparked my interest. I became once I had written about pawn shops, I became interested in check cashing. I discovered payday lending. I think I was the first person to write about payday lending because it came out of the check cashing field and was initially informally organized. And so I just found this fascinating, and I've stuck with it for many years. I've gone over time to many conferences devoted to fringe financial services, and I have to say this symposium is quite unique. For one, I've read all the papers because I was going to do the introduction, but for one, the knowledge of institutional details. One thing lawyers know is they get the facts right on the institutional details, and that comes out in the papers. That if you read the papers, you will learn a lot about how payday lending actually works, how overdraft protection works, how peer-to-peer lending works, microfinance outside the U.S., finance for for-profit trade schools and colleges. There's also in this symposium a great diversity of views. You heard a little bit of it being expressed on this panel. So there are people who believe that any regulation of free markets will simply push people into less desirable alternatives. There are people who take more of a behavioralist view that think that people could have cognitive failures, and so regulation could perhaps be welfare enhancing. There's also, unusual for an academic conference, a willingness to take strong stands on regulation. So the typical academic conference, and I'm guilty of this myself sometimes, is I duck the regulatory issue. So I've done a lot of research on how the institutions function. I know all the facts and so on. But when it comes to, and I'll talk about what regulation does, the trade-offs and this and that, but when someone pushes me to take a strong stand, I often avoid it, or other academics say, well, we need more research because we just don't know everything about it. But this group of scholars, most of them have really taken strong stands. And then, interestingly, there is quite a diversity of methodology. There's certainly legal analysis, a lot of, not surprising given the setting and the legal backgrounds of many of the panelists. Careful analysis of regulations, what regulatory agencies can do within legal constraints, maybe what they should do. Analysis of how new products that no one thought of 10 or 15 years ago fit into existing legal structures and regulatory structures. There's also, we have history. You saw it on this panel. There's a history of coercive loan sharking. I found that fascinating. Lessons from a TV drama. I've never been to an academic conference where someone drew fascinating lessons from this TV drama. A carefully econometric study that you'll see tomorrow. Jim's original survey of title loan customers, so he went into the street and talked to people coming out who had gotten title loans. And finally, you'll hear tomorrow an analysis of microfinance outside the U.S. and how lessons apply for that. So let me stop there. That's just a quick, just saying that I found the papers fascinating. I think you will too. There's a lot of great information here. The diversity of views will be a lot of fun. I'm looking forward to the rest of the conference and hearing a great, respectful clash of views and exchange of information. So thanks.